Hey guys, welcome back to the video with Stocks with Leah. It's been a minute since I've made my last video, but a lot has happened since my last video. As you guys know, there's been so much that's been going on with the police brutality, Black Lives Matter movement, George Floyd, Breonna Taylor, all these names, right? It's just something that keeps on happening. So it just felt really weird for me to come out and really weird and improper for me to come out and make a finance video amidst all of this. But I am coming back to YouTube because I feel like financial literacy is one of the things that is most important, and it's most important for people that look like myself. Because I've been reading a lot of articles about the wealth gap. The wealth gap is getting larger, and part of this has to do with the classism debate, right? And so the socioeconomic status and people growing up in certain communities that don't have the proper funding to get that education and to have different opportunities. So I feel like financial literacy is one of the key steps to that. And it's kind of one of the things why I'm back making videos. So subscribe to the channel just to see new videos from me. In this video, I'm going to be going over the top 3 stocks that I'm buying right now. Now, the stock market. The past couple weeks, it's just been on a tear since like the March 23rd lows. It's just been on a tear. So it's just kind of crazy to see. We did have some volatility the past couple of days, but really it's just been going up. So, as you know, like the tech giants continue to move over. That's one sector that's really doing well. Amazon, as you know, who's benefited from the lockdown, is up almost 30% year to date. Apple stock just hit a record high. And then overall, the S&P 500 is back to pre-coronavirus levels. Now, in my opinion, this huge run-up is not warranted, given the fact that I feel like a lot of these top companies are going to have long-lasting economic impacts that I feel like are not being priced in right now. With that being said, I already have a sizable position in Apple. I already have a sizable position in Amazon. I already have a sizable position in Facebook. So I kind of did not want to add these stocks, and I did feel that these stocks are kind of overbought right now. So I kind of wanted to focus on the stocks in my portfolio that were down, and that I think were a good value to buy right now. So the first stock that I've been buying is called Realty Income. I've talked about this company in the past. It's a REIT, so it's a real estate company that acquires commercial properties and leases it out to different tenants. Now it's called Realty Income, aka the monthly dividend company. So they've been paying a dividend every month while raising the dividend annually since 1994. And so if you're doing the math, that's 598 consecutive dividend payments monthly. I like this REIT in particular because they have a diverse portfolio, they have a strong balance sheet, they have good management, and so I think they are best in breed as far as REITs go. Now, going into what this company does, they have a diverse portfolio. Like I said, they have about 6,500 properties. They have tenants in 51 different industries. They are in 49 different states, Puerto Rico, and the UK. And that's not to say that Realty Income doesn't have any risk. They do have risk. The coronavirus is impacting them. It is impacting some of their tenants. So I want to go over kind of what's going on and how COVID is impacting them. So I will say that they have a diverse portfolio. A lot of their tenants are essential businesses. A lot of their tenants are still in business right now. A lot of their tenants are doing well, and they are paying rent. Now, as we see the hardest hit ones, the home and fitness, the health and fitness, the gyms, the restaurants, and then childcare. That's been kind of iffy as far as rent payments go. So a small portion of the portfolio is not paying rent. But they have collected, like I said, 84% of their rent in April, 82% in May. So we will have to see further how COVID impacts them. But just thinking about how they are as a company, I feel like they have a strong balance sheet. And I feel like that they are the best in breed as far as one of the best managed REITs. So I feel like coming out to the other side of this, that they'll be one of the REITs that actually do well and come out on the other side and continue to do well. Alright, second stock, AT&T. Everybody knows AT&T, wireless and media giant. Why do I like AT&T? AT&T pays a great dividend. So right now the dividend is around 6%, and they have around 35 years of dividend growth. So AT&T is doing a lot right now. As you know, the wireless space is so competitive. They acquired Time Warner in 2018 to kind of diversify their business. And so that's now Warner Media, and one of the key growth strategies to Warner Media is now HBO Max, which I'm sure you've heard of. They've been pushing that heavy, HBO Max. So we kind of have to see what's going to go on with that. So one of the reasons why I like AT&T is they've been taking on acquisitions to kind of diversify their business. And as you know, like, they've taken on a lot of debt, right? But they have been paying down their debt. They've been deleveraging, and right now they're a cash flow machine. So I feel like they're a huge company. This is one of those stocks where you sleep well at night, which people call Swan. Sleep well at night stock that you can own. Now, as much as I love this stock, I will say there are risks to every stock. And I really like to list, you know, why I love this stock, but also you have to admit that there are risks to every stock that you invest in. So one of the risks of this is that this launch encounters some challenges with people signing up, and then they also did not partner with Roku and Amazon's Fire Stick TV, which would have helped them so much. And then one of the things that has been plaguing them, and I think will continue to plague them, especially with the stay at home, is the cord cutting. People are cutting their cord right now. So that's kind of one of the things to look out for. And you know, we have to see what they do with that. But that's kind of one of the risk factors right there. But overall, I think AT&T is a really, really big company. It's a giant company. I think they're making all the right moves in terms of diversifying their businesses. They're open up to all these different things, and then also they have a great balance sheet, great free cash flow, and they're able to support a good dividend. So I think overall it's a great company. Now my third company that I've been buying, JP Morgan Chase. This is the largest U.S. bank by assets. And one of the things I look for when I'm looking for companies is not only, you know, the balance sheets, not only the valuation metrics, not only the key financial metrics, but also its management, which I think a lot of people overlook, you know, because management is one of the things that I think, you know, is a deal breaker in a company. It literally makes or breaks that company. And a lot of people don't, you know, pay attention to them. They'll just look at numbers or something. But I think there's a quantitative way to assess stocks, and there's also a qualitative way to assess stocks. So I like to look at the track record of the management team. I like to listen to earnings calls. I like to actually, you know, try to understand the management and where they're going, what direction they want to head in, and how they've done in the past. So Jamie Dimon has been the CEO of JP Morgan Chase since 2005. He's led the bank through the 2008 financial crisis, which, as you know, like, the banks were like the key cornerstones of that and getting hit the hardest. So he led the bank through that, and then he built the bank up to what it is today. And I think banks are a lot more resilient now than they were in 2008. There's a lot of new laws and regulations in place. And then listening to the last earnings call, the JP Morgan, a lot of these banks have built up a lot of provisions in case of defaults that are coming, and they have a lot of capital. So just looking at the area today, I feel like banks are going to get hit with the coronavirus, with the low interest rates that the Fed have in place, with the coronavirus, with some defaults coming, most certainly, that they are going to get hit by the coronavirus. So short term, I'm kind of bearish on bank stocks, but long term, I'm looking like 20 years out when I buy stocks. So I'm kind of like not looking like these short term moves. So 20 years out, I feel like JP Morgan the best in breed. Good management, good balance sheet, valuation metrics. They're trading at a low price to book ratio. So just a little bit on banks and valuing banks, so just looking at different things. So one of the things that's kind of going to hurt banks in the short term with the Fed rates being so low is that, you know, when banks take in deposits, like if I were to deposit money into the bank, into my savings, they would give me a little bit of interest on that. Just, you know, just a little bit, you know. Banks don't really have a lot of high yields, but as opposed to like credit unions and high yield savings accounts and things like that. So, you know, they'll pay you a little bit, but when they have loans, they'll have interest on the loans. They'll have a little bit higher interest on those loans. And then that spread between what they're getting from that interest on the loans they loan out and what they pay for deposits, that's called net interest margin. So that spread right there is kind of how they make their money in the most basic sense. So when the Fed rates are low, what they loan out and their interest is going to be a little bit lower. So their net interest margin is going to be a little bit lower, and that spread is going to be a little bit lower, which means less profit. ultimately, in the most basic sense. So that's kind of one thing to look out for. So that's why I say in the short term I'm bearish, but in the long term I think JP Morgan is best in breed in the fact that if you look at their return on tangible common equity. So what does that mean? Their return on their tangible equity is when they reported earnings, it was 19%, which is higher than what a lot of banks have. And I won't go into like the nitty gritty of like all the valuation metrics I look at in a bank, but all the efficiency ratios, all the different ratios, I think, you know, they are really best in breed compared to other banks. So JP Morgan is a buy, and like I said, their price to book ratio was down. So they were, as a valuation metric, I thought they were undervalued at the time that I bought. So that was the 3 stocks that I bought. Soon enough, I'm going to make a video with my whole portfolio. And I'll go over like all the stocks that I'm in currently. But those are 3 stocks that I have been buying right now, and I hope to hold for the next 20 plus years. What stocks have you been buying for the long term, short term trading, whatever you're doing right now? What have you been buying? Leave a comment down below. Subscribe if you have not already to see videos just like this one. And I'll catch you in the next video.